Morning, all of you. Welcome to this session on alternative investments. We are using a new tool, right, Zoho. So, just a quick check. Are you able to see the presentation, and am I audible to all of you? Because I'm also getting used to this new tool. But just a quick confirmation, I'm audible to all of you, and you can see the alternative investment presentation on your screen before we start. Okay, perfect. I think the chat box is here. Okay, all good. Let's wait just a couple of more minutes, expecting others to join in, and I think we should start in another 2 minutes. Sit back, relax, and I think we'll pick up on alternative investments. Actually, perfect. We'll start. So, quick update on alternative investments. Alternative investment is a fairly small portion of CFA level one. That said, the content or the curriculum is also very, very small or very short. It's a largely theoretical topic. We have been allocated, I think, today and tomorrow 2 days to cover alternative. I don't think we'll need full 2 days. We should be able to finish it, or we'll split it between today and tomorrow. I just don't want to rush through the topic, but I don't think we'll need the full allocated time frame to complete the syllabus on alternative. That said, let's begin on alternative then. Let's first talk about what are alternative investments, alternative asset classes, and how do they differentiate with respect to the traditional asset classes or traditional investments that a lot of us are in generally investing in or read about. So when we say alternative assets or alternative investments are assets which are excluding equity and bonds, basically everything else. So from real estate to commodities to private equity, hedge funds, the newest or the perhaps the latest thing on the block is cryptocurrencies, collectibles. Everything is alternative asset class or classified as an alternative investment. Equities and debt or equities and bond market are your traditional asset classes or traditional investments. What makes alternative investment different from traditional asset classes? What are the key features which differentiate them? One, narrow specialization of investment managers. So in equity, if you're investing in equity, if you're investing in stock markets, you are equally comfortable perhaps in investing in bond markets, right? So you can switch over to asset classes fairly easily. But these are such specialized asset classes that investment managers or fund managers who are managing these types of asset classes, which are alternative assets, are generally considered niche, which means if they are a champion on private equity, it is possible they don't understand commodities, or if they're managing commodities, there may be a possibility they're not someone who would be comfortable doing cryptocurrencies. This is the entire reason why CFA has a different program around alternative assets, which is called as a CAIA. Like we have a chartered financial analyst, that's a chartered alternative investment analyst program, a very niche asset class and something which needs a lot of details in terms of that specific asset class per se. So narrow specialization of investment manager is one thing which differentiates alternative versus traditional asset classes. Relatively low correlation of returns with those of traditional investments. In portfolio, you would have read that we need low correlation in our portfolio to get diversification benefits. Now, these asset classes offer low correlation with traditional investments, and that is what makes them a very, very attractive bet from a portfolio investment perspective, right? Classical hedge, for example, is gold. A lot of people will tell you that if equity markets are not doing good, perhaps it's time to put some money into gold, because gold is something that can offer you a good hedge for your portfolio. So traditional asset classes have relatively low correlation, which means they are good for a diversification purpose. And it's all relative. It's relative to traditional investments. That said, they have less regulations and less transparency than traditional investments, which in a way increases the risk of investing in a lot of these alternative investments. Your traditional investments like equity and bond markets are very well regulated. Uh, you keep reading about around regulations and how investors are protected in equity and debt markets. On alternative asset classes, there is a lesser transparency. Doesn't mean they are they're poor investment choices, but the point is it's all relative to the traditional investments. They have less regulations or less regulated, and they have a lesser transparency per se, which increases the risk, and along with risk, obviously, returns and losses can increase proportionately. Limited historical risk and return data. They are relatively new asset classes. Equity and debt has been out in the market for now several decades. But like cryptocurrencies, or when you look at new types of asset classes, there is a very limited amount of information available on some of these asset classes to do analysis or do a historical risk and return analysis. Unique legal and tax considerations. A lot of these asset classes operate across the globe, right? So they are not an asset classes which are very, very specific to a geography. And each asset class has its own taxation and legal considerations depending on the geography and depending on the asset class. Like real estate would be taxed differently across the globe. So the tax considerations and legal considerations are more specific to the geography in which these asset classes are placed, and accordingly the rules may change. For traditional asset classes, the rules are pretty similar across the globe with very, very small deviations in terms of how the rules are placed. Higher fees, often including performance or incentive fees. Towards the later part of our reading today, we'll talk about fees in detail, right? But at present, if you're a fund manager under this alternative investment category, the fee income is in general on the higher end, which includes two types of fees. One is your management fee and the other is your performance or incentive fees. Concentrated portfolios in alternative investments, the bets are concentrated, which means they generally do not believe in diversification. They go all in, right? Like you talk about poker. In poker, once you think the bets are in your favor, you're going to go all in the game. Alternative investment is very similar. They have concentrated portfolios. They invest into one or two big themes for a year or two, and they would like to encash on those themes. So for them, diversification is not an objective for them. Making a concentrated portfolio is an objective, because if the bet goes right, there are a lot of profits, but they have full cognizant of the fact that if the bet goes wrong, there are losses equally large. And then there are restrictions on redemptions. Lockups and gates are available. So while we talk about fees, we'll talk about redemptions also. In mutual fund, for example, you can quickly redeem, right? You can place an order and in a day or two, you'll get your money back. But in this, there are lock-ins where you cannot redeem before a specified time period, and you have to stay put in an investment, which makes them, in a way, a bit illiquid as a security. But these are some of the features which differentiate alternative asset classes from traditional asset classes. In addition to this, categories of alternative investment, when we said, we did talk about, yes, there are hedge funds, there are private equity funds, and within private equity, you could have equity or debt, right? When we say private capital, you would have equity or debt investing. Real estate, natural resources are all alternative asset classes, whether you talk about commodities, agri, or you talk about timberland or farmland type of investments. Infrastructure and other tangible assets such as fine art, antiques, automobile, collectibles. Basically, you collect whatever you want to collect. It has a value, right? All of that are classified under the alternative investment category. And this is just an indicative list. Please remember, you can add many more assets to this category, which will fall under the alternative investment bucket. Now, from an alternative investment perspective, there are certain investment methods, right? So we need to understand how these methods differ from each other and what is the benefit of picking up either of the three. The three investment methods that we work around in alternative are fund investment, co-investment, or direct investment. When we say fund investing, it is a pool of fund wherein investors contribute capital, and the fund identifies, selects, and makes investment on investors' behalf for a fee which is based on the amount of assets being managed, which is why this fee is called as assets under management or management fee. If you are managing $100 million of asset, 2% may be the management fee, which means you're going to get $2 million as management fee because you're managing those assets. So this fee is based on the amount of assets being managed. A performance fee is applicable if the fund manager delivers superior results, which means if you obviously deliver profits. Fund investing is available for all major alternative investment types, including hedge funds, private capital, real estate, infrastructure, or natural resources. So this is pretty similar to what we talk about as mutual funds in the traditional investment category. This is targeted towards investors who will like to invest in a pooled investment vehicle, who do not have a lot of corpus to invest upfront, or who are basically small investors. They can invest into alternative asset classes through a fund investing style. Like mutual funds, if you're making a fund investment, you do not have the discretion in deciding what to buy, when to buy, what to sell, when to sell. You are basically just giving the money, and the fund manager has the authority to decide on the investment decisions. In co-investing, on the other side, from a co-investment perspective, the investor invests in assets indirectly through the fund, but also possesses rights known as co-investment rights to invest directly in the same assets. So you can invest indirectly through the fund, and then you also have the rights to invest directly in the same asset. This is therefore co-investing approach, where you will identify a fund, and then based on the fund, wherever the fund invests, you can also invest parallelly in those securities. So through a co-investing, an investor is able to make investment alongside a fund. When the fund identifies deals, the investor is not limited to participating in the deal solely by investing in the fund. There are certain advantages of, for example, timing. You can put more money, and you can have your own say in terms of when you want to withdraw the funds if you're doing a co-investing. Along with this, co-investing also helps a lot of investors expand their knowledge base, their own skill in terms of the investment that they are making based on fund. They are trying to analyze what the fund has done, and perhaps we can also do that. This also lowers the fee, because if you only invest through the fund, you have to pay higher fees always. But if you are going to invest directly alongside a fund, you can lower the fee, because then you are investing on your own. You don't have to pay a fee to a fund. Direct investing, on the other hand, is nothing to do with the fund. It occurs when an investor makes a direct investment in an asset without the use of an intermediary. In private equity, this may mean the investor purchases a direct stake in a private company with the use of a special vehicle, such as a fund created for himself. And institutional investors typically begin investing in alternative investments via funds. So options are available. Now, advantages, disadvantages of all of them. Right? For example, this is a co-investing chart where the fund is also investing and you are also as a limited partner co-investing it. Okay, where is the writing tool in this Zoho? Just give me a minute. I have to figure out, do we have a writing tool here? Okay, I don't see one. I don't see one here as such. No problems. From a investing perspective, when we say there is a fund manager and there is a limited partner or an investor, what do we mean by a general partner and a limited partner? Now, throughout alternative investments, you're going to hear the word GP and LP, general partner and limited partner. Let's sort it out upfront. A general partner is basically the fund manager. He is the person who's going to take the decision in terms of where to invest, what to invest, when to invest. The limited partner is the one who is going to put in the money, right? He is the financial investor in this setup. So the money comes from the limited partner, and the general partner is the person who's going to manage the fund. The fees is payable to the general partner. The general partner gets the fees for managing the money, for earning profits for the fund. So a GP and LPs will set up an alternative investment fund. There could be one limited partner or there could be more than one limited partners. And the limited partner, if goes through the fund and makes investment into an asset investment 1, 2, 3, that's a fund investing, indirect. The other is the limited partner can identify investment A and directly invest there without a fund. And the third category, which is something which we talked about as a hybrid, you invest through a fund also, and you also invest some directly in asset 3, which is your co-investing approach. So it is up to the limited partner's risk-taking appetite. Would you be okay investing directly and managing that asset directly? Would you do a co-investing, or would you like and prefer a fund investing? Like a lot of us do only mutual funds, that is fund investing. Some of us do only stock market direct investing, that is your direct investing approach, where you purely invest individually on an individual basis into equity markets. And there's a co-investing where some of us have some mutual fund SIPs also running, and we do some direct trades also in equity market. That is a co-investing approach. Advantages, disadvantages for all three. When you're doing a fund investing, fund manager offers investment services and expertise. Obviously, mutual fund manager, like mutual fund manager, alternative asset manager also offers you that expertise. Comparatively lower level of investor involvement. We just have to offer our funds and sit back and see what returns can be achieved by the fund. Potentially valuable diversification benefits, lower capital requirement, pooled investment vehicles. Whenever all of us are investing together, it's a pooled investment vehicle. The diversification benefits and capital requirement, specifically the capital requirement, is lower. You don't have to start with a very large capital. You can start with smaller amounts also. Low to moderate degree of investment expertise required. And if someone belongs to a category where they don't understand a lot of the investing jargon, perhaps mutual funds, or like in alternative investment funds are a very good approach to start. Disadvantage, they're costly management and performance fees. Obviously, if you're taking the help of a professional fund manager, a general partner, fee will be payable. Investor, to conduct due diligence while selecting the right fund due to wide dispersion of fund manager returns. Again, there are so many funds, there are different types of returns, the CAGRs and 5-year returns and 3-year returns. You have to do your own due diligence before picking up a fund, whether you are investing into the right fund or not. In co-investing, your fee reduces because some of your investments you are doing directly. It allows more active management of the portfolio compared with fund investing and allows for deeper relationship with the management. So what is active management? Active management is where you can take your own decision whether you want to buy or sell securities. Because you're doing a part of the investing is direct, right? You are doing some co-investing in which some of the investments you are making on your own. You have that authority to take a decision, okay, I want to sell the security or I want to buy more of the security. Investors can learn from the fund's process to become better at direct investing. Because you're doing co-investing, you can learn what the fund is doing, how are they selecting securities, when are they making investments, and you can improve your investment knowledge and skill. Reduce control over the investment selection process compared with direct investing. Now, you are doing a co-investing. That doesn't mean you are selecting securities. You are just mimicking what the fund is doing, which means your control over what you want to select and invest is a bit lower. You may be subjected to adverse selection bias, right? If there is a bias at the end of the fund where they make poor investment choices, you may be subjected to such choices as well. Requires more active involvement compared with fund investing, which can be challenging if resources and due diligence experience are limited, right? So in mutual funds, and I keep taking the analogy of mutual fund for teaching this subject, but in mutual funds, you don't have to take any investment decisions. You just have to give your fund money and then you have to sit back and see what returns can be delivered. But if you do co-investing, you will have to be actively involved. Okay, I'm to buy, I want to sell. You have to do due diligence, whether the security selected is correct, not, experience. So you will have to be a bit more aware about what is happening, a bit more financially, astute if you're trying to get into a co-investing style. Direct investing, on the other hand, takes you to the extreme end of investing. From fund investing to direct investing, you have completely flipped your approach. You want to avoid paying management fees to external manager. You don't want your mutual fund manager, or you don't want to pay fees to the manager. Greatest amount of flexibility because you are driving the entire game. When to buy, what to buy, when to sell, what to sell, how much to buy, how much to sell. You are taking all the decisions. Highest level of control over how the asset is managed. Requires more investment expertise, resulting in higher internal investment cost. Obviously, then you are completely aligned with what you want to do. You should have the necessary skill set to do it. Less access to a fund's ready diversification benefits or the fund manager's sourcing network. You have moved away from funds, so you don't get any of those benefits. Requires greatest level of due diligence because of the absence of a fund manager. And direct investing means you're putting all your money into this, so your obviously fund requirement goes higher. So it is an approach that changes for all of us. It is an approach which we have to decide whether you would like to go completely passive, which is fund investing. You want to go completely active, which is direct investing, or you want to take a hybrid approach, which is a co-investing approach, right? It is based on time availability. It is based on your skill sets or your expertise in managing asset classes, which helps you or enables you to take these decisions. Now, investment and compensation structures. Whenever these funds are established, there are terms which are decided between the general partner and the limited partner. Because these are partnership structures, These are called as partners, general partner or limited partners. Most of these funds are established as a partnership structure. General partner, as I've discussed previously, can run multiple businesses at a time, and they notionally bear unlimited liability for anything that goes wrong. They are the fund managers, right? If anything goes wrong, they have the liability to explain why things went wrong, and they have in general unlimited liabilities. So you can manage multiple funds at a time. When it says multiple businesses at a time, it means a general partner can manage multiple funds at a time. Obviously, a limited partnership agreement will be signed every time a new fund is launched. Limited partner, on the other hand, are generally recognized investors who are expected to understand as well as assume the risk associated with investments, which are less regulated than offerings to the general public. They are therefore called as limited partners because their risk is limited to the amount of investments which are made. So if you're going to make investments worth $50 million, as a limited partner, your risk is $50 million. At best, what you can lose is $50 million. And which is primarily the reason they are called as the limited partners. Their risks are limited. General partners, the risk is unlimited. The GPs and LP partnership is governed by a LPA, or a limited partnership agreement, a legal document outlining the rules and framework of the fund's operation. Along with this, you can also have additional supplemental documents like side letters. These are issued or again signed between a GP and one or more LPs, right? You could have one or more investors. If you look at the diagram below, the general partner and the limited partners would be one or more limited partners. These side letters or side agreements which are created between GP and LP, this is besides the LPA, besides the limited partnership agreement. These, why would you typically sign these side letters? These side letters are typically sort of amendments. You can think about it as amendments. They can override or modify the original terms mentioned in the LPA, right? So basically, what terms can you change? You can change the terms with respect to management fee. You can change the terms with respect to performance fee. There are several other clauses like right of first refusal. So any type of modification that is required to the limited partnership agreement, side letters are used to make those modifications or override the terms present in LPS. So that's typically the way the structure is. You set up a fund in which there will be general partner and limited partners. Limited partners have unlimited liability, or limited partners have actually limited liabilities, while general partners have unlimited liabilities when these funds are set up. Now, what are the type of fees which a general partner gets? Always remember, the fees is payable to the general partner. The first and basic fee is management fee. From a compensation structure perspective, the first thing that the general partner gets is a management fee. Management fee is basically based on your assets under management. If there is $100 million of asset, as I said, you could be paid a 1% to 2% fee on that assets under management or committed capital, where the total amount committed LPs to fund future investments. So this is a flat fee. Basically, this is not a variable fee. This is a flat fee structure. Irrespective of what the returns of the fund are, you are always going to get this flat fee. Then comes a performance fee, which is also known as a carried interest or incentive fee. You can call it anything out of the three. This is only payable, as the word suggests, if you deliver performance. If your fund is able to generate returns over and above a desired level at times, or deliver positive returns, then a performance fee is payable to the general partner. Once again, remember, performance fee is a variable fee, right? Obviously, it is based on profits, the amount of profits you generate, and accordingly, the fee would be payable. So performance fee is largely based on the returns generated. It's a variable fee. Management fee is a flat fee or a fixed fee that would be paid. Whether it will be 1% or 2% is something that is to be decided, but once decided, that is fixed. Then comes not a type of fee. I think the heading or the label is correct. Is incorrect there rather. The hurdle rate should be part of the clauses category at the bottom of the slide. So what is a hurdle rate? Fee is management and performance. What is a hurdle rate? Hurdle rate by the word itself tells you that is the minimum return that the fund has to deliver. It is the minimum rate of return, typically let's say around 8%, that the GP should exceed in order to earn the performance fee. So if you're starting with $100 million and if you do not cross $108 million, incentive fees is not payable. There is a possibility that you delivered $105 million, 5% return. But if there is a hurdle, and again, hurdle has two classifications, hard and soft hurdle. There is a possibility if there is a 8% hard hurdle, then no incentive fees is payable, even though you have made a $5 million profit. So if it is 8%, GP should exceed this in order to earn the performance fee. The hurdle rate is usually specified in the partnership agreement between soft hurdle and hard hurdle rate. Fees is paid only on annual returns net of hurdle rate in case of hard hurdle. While in case of soft hurdle, it is calculated on the gross annual return as long as the hurdle rate is exceeded. So how does it work? Let me just open up an Excel sheet because I don't see an option of pen here. Please let me know if you can see the Excel sheet. Is the Excel visible? Okay, perfect. Zoom had a better interface, I think. Zoom used to show me what you guys can see on your screen. I don't know what led to this change, but that's fine. Okay, what is the difference between a soft hurdle and a hard hurdle rate? So let's say this is your beginning AUM, beginning assets under management. $100 million. And we have set up a hurdle rate. Soft hurdle 8%, hard hurdle 8%. Right? In both cases, we have set up a hurdle rate at 8%. The difference is one is a soft, the other is a hard. The ending AUM, assets under management, is $110 million for both the funds. So returns applicable for performance fee or first threshold to earn a performance fee. You have to cross this to get any performance fee, and that threshold for all of us It's fairly simple. You need to cross $108 million to earn any performance fee. So profits on which performance fee is payable. In this case, because you have crossed the hurdle, you are at 110, your hurdle was 108. Because you have crossed the hurdle, the profits on which performance fee will be payable is this minus 100, right? So on the entire $10 million, you are going to pay a performance fee, let's say at 20%. So on this $10 million, a 20% fee would be payable to the general partner. So you take into consideration the entire profit if the hurdle is crossed. On the other hand, in a hard hurdle, if the hurdle is crossed, the performance fee is only payable on the difference from the hurdle. So your performance fee is only payable on $2 million. The concept being that if you are giving me $110 million of return, I am only making $2 million incremental because $8 million I would have already made by investing into a fixed deposit. So what is so great about your fund? Your fund has only made $2 million incremental. And on that too, I am happy to pay you 20% fee. So this is, I think, the primary difference between how a hard hurdle or a soft hurdle will play out, depending in terms of the way the math works. But yes, if the hurdle is not breached at all, if you're at 107, this fee will be, or this profit will be zero. You have not even crossed hurdle. So if you have not crossed hurdle, irrespective of wherever you are, there is no performance fee. You have to cross minimum the hurdle rate to get to any type of performance fee incentive. From a management fee, let's say at 2%, it is always on beginning AUM, right? In exam, in case if a basic question comes in terms of calculating of management fee, it's always on beginning assets under management because you started with this. So 2% of $100 million, it's fixed that you will get. So those are the two types of fees that we need to consider, and based on the type of hurdle rate which have been set up. If there is no hurdle rate, no problems at all, right? If there is no hurdle rate at all, right? And if you simply say there is no hurdle rate, then this becomes irrelevant. Then you don't even care about what the returns are. You can simply say, even if I do $103 million, on $3 million, I will be paid 20%, and this remains fixed. So there's no hurdle to be crossed here. So this is irrelevant as a threshold. So you could have any type of structure when you're looking at a fund, no hurdle, hurdle, or soft hurdle, hard hurdle. Fairly clear? Questions around hurdle? Okay, perfect. Actually, back to the presentation. So this is about hurdle rate. Then comes other clauses, provisions, and contingencies. Catch-up clause. For a general partner who earns a 20% performance fee, a catch-up clause allows the general partner to receive 100% of the distributions above the hurdle rate until he receives 20% of the profits generated. And then every excess dollar is split between LPs and GPs. So catch-up clause is basically, in a way, accelerating your performance fee. As soon as you cross the hurdle, then if there is a catch-up clause, in a catch-up clause, you will get excess fee. You will be able to make a lot more fee as compared to what you will have without a catch-up clause, right? So for example, if if there is a 8% hurdle. Okay. So after you have delivered 8%, you will only get your performance fee and management fee, right? You won't have anything additional over and above the performance and the management fee. But if there is a catch-up clause, then you can basically split whatever is additional in a favor in a portion of 80-20. So this helps you accelerate or make more incentive fee as a general partner. Again, whether there will be a catch-up clause or not is largely dependent on the negotiations between the fund between the general partner and the limited partner. So it is all dependent on how strong is the general partner in the negotiation, because negotiations are critical in setting up or signing up that LPA. Then there is high watermark. Okay, this is very interesting when you look at a high watermark category. There is a possibility fund goes up in value, then fund comes down in value, then goes up in value, then comes down in value. You cannot be paid a fee again and again on the same profit. So what do I mean here? When I say high watermark, you started the fund on $100 million, assuming there is no hurdle, ending AUM, and this is year 1. 120 performance fee, 20% of the difference. Sorry, 20% of the difference. You got a $4 million incentive fee. Okay, so your net ending AUM, and we should also actually subtract the management fee into 2%. Perfect. So we have 4 calculations. So your ending AUM from 120, you're going to pay $2 million management, $4 million incentive. You are left with 114. Year 2, you start with 114. This is 2% of 100, 20% of the difference. From your ending portfolio, you spend $6 million on fees. You start the year at 114. The fund goes into a loss and you are at $100 million ending. Management fee has to be paid irrespective of whether you are making a profit or loss. Incentive fee 0. You end the fund at 97.72. Now, year 3, you start at 97. You go back to 120. Good year. You got a 2% management fee. And you say that I want a incentive fee again. Because I have increased the profits from 97 to 120, I've made profit this year. I want an incentive fee again. If there is a high watermark, you have not crossed your previous high in terms of AUM, and therefore no incentive fee is payable. You cannot ask for the fee again and again for the same profit. I already paid you an incentive fee for 100 to 120. You cannot ask for the same profit again because if I keep doing this, I am not making any money. Rather, I am just paying fee every time on the same $20 million profit. So this fee will not be payable. You have to cross the above or cross above 120 to get any payments in lieu of your incentive or in lieu of your performance. So if a fund subsequently declines in value, then performance fee is not payable till you exceed your previously set watermark level or previously set high watermark level. The LP would not want to pay twice for the same return. That is basically the way a high watermark works. So when we say high watermark, highest value of the fund investment ever achieved at a performance fee crystallization date. This is used while calculating fees in case of hedge funds and even in case of private equities in certain cases. So as a limited partner, you want to be cognizant about the facts that what type of clauses you want to include in the LPA, the limited partnership agreement, because it all impacts your net return. Your gross returns and net returns are all dependent on the types of fees or the hurdles you set. Comes a waterfall structure. Waterfall structure representation of distribution method defining the order in which allocations are made to LPs and GPs. Right? So you will write typically a waterfall that, in what style are the payments going to be distributed between the two entities. Will it be a deal by deal structure, which is the American waterfall, or will it be a consolidated whole of fund structure or a waterfall like a European? So if I'm going to make investments into 20 different companies as a general partner, for each investment, will you make distributions? For example, if I sell the first investment and if I make profits, will that be distributed investment by investment, or will it be on an aggregate basis? That needs to be taken into consideration. Then comes clawback. It reflects the rights of limited partners to reclaim part of your general partner's performance fee. You can ask the performance fee back. You can ask for the general partner to pay that fees back. Samay, just a minute. Let me just look at the Excel sheet. So Samay's question is in year 4, if we start at 118. Okay, perfect. Let's just model your scenario here. I will just put up in year 4 for you here. If we start at 118 and if we end at 130, then for incentive fee, profit is considered as 130 minus 118 or 130 minus 120, right? Because you have already paid till the highest watermark, right? So in this case, what you're going to do, you're going to take maximum of prior years. So 130 minus 120, and on the remaining $10 million, you pay a 2% because that was your previous highest watermark. That is the entire reason of setting up a watermark, that I don't want to pay a fee again and again for the same profit, which means you have paid once because the person made 120, and till he doesn't cross 120, he doesn't get anything. If he makes it at 120 again, no performance fee. If he makes a 119, no performance fee again. This will be maxed out to the number, comma, 0. But yes, if he gets to 131 or 121, even if he gets to 121, he makes on that $1 million additional 20%, because that's fine. He has crossed his previous highest threshold. Yeah, so in clawback, what happens is, in clawback, it reflects the right of LPs to ask the GP to pay back some of the performance fee, and it is usually activated when a general partner exits successful deals early but incurs losses on later deals, right? So in initial phase, you have made a lot of money, but later you are making losses. So in that case, you have to pay back some of the performance fee. This is a clause available, right? You have to ensure this clause is available. From a fee structure perspective, I think I won. Yeah, from a fee structure perspective, these are the types of fees which are available to a general partner. The general partner can get this fee or earn this fee based on performance, based on management, etc. Let's move to hedge funds. Now, from a hedge fund perspective, these are, again, you can compare them on a very similar grounds like mutual funds. The features are, or the structures are very similar. The only point is the type of investor profile changes, the type of asset classes in which they invest changes. But end of the day, they are also a pooled investment vehicle. Hedge funds use long and short positions with an aim to deliver strong absolute returns. When we look at hedge funds, to begin with, these are asset classes which are operating across the globe. They do not invest in one specific geography. They are asset classes which are spread across multiple geographies. These are typically pooled investment vehicles like mutual funds. And the only difference is in mutual funds, generally small investors may be a part of the investment fraternity. But in hedge funds, given they are pooled investment vehicles, you typically see participation from institutions or high net worth individuals. The HNI investors will be typically, or the HNIs will be a part of this category. Along with this, hedge funds are typically more flexible in terms of their investment strategies. Unlike mutual funds or ETFs, which are very, very driven by the prospectus which they design. This makes hedge funds more risky, but this also gives hedge funds the ability to generate higher profits with a complete knowledge that losses could be commensurately high. Different varieties of strategies are used in attempt to generate investment gains, and therefore hedge funds may not necessarily hedge risk. A lot of people, when they read the word hedge fund, they believe this has something to do with hedging the risk. Not necessarily. The name hedge fund should not confuse you. These can be set up for several other purposes apart from hedging the risk. What defines them, or what are their key features or characteristics which are which will differentiate them as compared to other asset classes? They have the goal of generating absolute returns. So they don't care about what the percentage return is. They are looking at absolute returns. When we say absolute returns, they are more interested in understanding how many dollars has the fund generated. Key thing to note, a lot of people, when they make returns, they talk about absolute or relative return. Relative return is comparison against a specific benchmark. Right? For example, a mutual fund may offer you a relative return where it says, my fund has outperformed the benchmark by 2%, which means if Nifty gave a return of 4%, I gave a 6% return. But is that 6% good enough for you? That is a big question. So they will say, obviously, we have outperformed. We have done better than the Nifty. But my target was not 6%. My target was 18% or 12%, which is where relative returns are a misnomer, right? End of the day, a relative return can hide the poor performance on a of a fund, because relatively they are better than Nifty. On the other hand, hedge funds, they focus on absolute return. which means they will set up a number. For example, we need 18% return, irrespective of what the benchmark does. So they are concerned with the return of a particular asset, and they do not compare with any benchmark. They target a specific return and they would like to deliver that absolute return. They are very aggressively managed and invest in multiple asset classes. So they don't have any problems in investing across multiple asset classes, whether they are currencies, equities, bonds, commodities. They will take a position wherever they believe returns are available. What makes them very, very different than mutual funds is the use of derivatives and the use of leverage. Two words: derivatives and leverage. If you're going to do derivatives, if you're going to use all types of derivative instruments available, futures and options and forwards and swaps, in a way you are trying to take additional risk to magnify returns with the complete knowledge of losses that can happen, losses that can occur. So by taking derivatives as part of their trading strategies or investing strategies, they are basically magnifying their risk and return and losses. Along with derivatives, they further enhance their risk, return, and losses. I keep using the word risk, return. Along with risk and return, I've started using losses with the use of leverage. The more leverage you take, the more borrowing you do, the higher the returns and the higher the losses, depending on how the strategy plays out. So they take large amount of derivative and leverage based positions, which help them magnify their returns and which can go against them and maybe just throw them out of the business. These hedge funds take both long and short positions. So they are not someone who is, you know, at one end of the strategy that we are we are long only fund or we are short only fund. They can change and swiftly move their positions from long to short, short to long, depending on how the market plays. They are momentum chasers in a lot of markets. They have very few investment instructions because these are not heavily regulated. Remember initial slide we said they are less regulated, less transparency. Because they are not heavily regulated, they have very few investment instructions. They would perhaps move very swiftly across markets, across asset classes to exploit any mispricings. They are once again set up as private investment partnerships with very few investors. So the GP-LP structure will continue even for hedge funds like private equity funds, hedge funds, all of them will have a GP-LP structure. They impose restrictions on redemptions. You cannot redeem at your will. You have to serve a lockup period, and you may also have a notice period before you ask for redemptions. Now, hedge funds operate under four broad strategies, or you could have four different types of hedge funds that you may look into. Like in mutual funds, we have equity funds, debt funds, hybrid funds. Similarly, in hedge funds, you could have strategies. Some funds use equity strategy or equity hedge. Some of the funds may be event driven, while some other funds may have a relative value or macro strategy. Just give me a minute, please. Okay. Class, let's take a 10-minute break. I just need to take some medication for a bad throat. So take a 10-minute break, and I think we'll pick it up right after the break. Okay, perfect. Let's pick it up again then. So we were talking about strategies, and when we said mutual funds, there are different types of mutual funds. Similarly, hedge funds have different types of strategies, or you can call them different types of hedge funds. First is an equity hedge, or something which is a hedge fund, or which are hedge funds driven by equity hedge fund strategies. They use bottom-up approach as it explores opportunity in individual securities. So most of these equity funds are follow a security-specific approach. When we say security-specific approach, they go bottom up. Bottom up means they first do a company level analysis and follow this by, let's say, an industry analysis and subsequently a economic analysis. So their approach is largely bottom up. In this, they can also act as market neutral, which means they take long positions in undervalued securities and short positions in overvalued securities. In a way, they are not long, they are not short. They will put their money equally on the long and short strategies, creating a neutral portfolio for them on a overall basis. Besides this, a lot of these funds can have fundamental growth or fundamental value, which means from a growth perspective, only shortlist companies with high growth and capital appreciation possibilities. So if you want to classify securities from a growth perspective, capital appreciation perspective, all the companies which will exhibit very high growth initially may not offer you a lot of value, which means they will trade at very expensive valuation multiples. PE multiple, price to book value multiple, will be on the higher end. Classical example could be companies such as and you know, we talk about high Ps. High Ps have to be talked about from an emerging market perspective. So like in India, a lot of people bet on Zomato. Zomato is an example of a very high growth and a capital appreciation driven company, because people believe there is a future of Zomato or a future of Blinkit from a hyper local grocery quick commerce setup. So fundamental growth funds or hedge funds will look at not only equity, but these are primarily equity oriented securities. So these are equity hedge securities. So their functioning is more on the equity side of the investment asset class. Value, on the other hand, identifies undervalued securities. They may not have a lot of growth, but they are trading at relatively lower or cheaper valuations. And therefore, the hedge funds will take long positions in these companies with the expectation that stock prices will rise in future. Some of the funds may also offer a quantitative directional strategy, where technical analysis is used to identify overvalued and undervalued securities. Then next, under the equity hedge category, could be short biased securities or short biased funds, which can use technical or fundamental analysis to take short positions on overvalued stocks. So a lot of us, when we heard the name of Hindenburg, that was a fund which is more short biased as a hedge fund, right? They generally try and figure out fundamentally what could go wrong with businesses or what is the problem with the businesses, and they would take a short across those asset classes before and they based on their own research. In equity hedge fund strategies, you can again find sector specific, which are called as thematic investing, where they focus on a particular sector, again using technical or fundamental analysis. So from our exam perspective, we just need to remember what are the fund strategies, and in one or two lines what these strategies individually mean. It's all theoretical. There's nothing in terms of at present designing any of these strategies, but you could be asked, for example, fundamental growth is what type of strategy? Is it equity hedge strategy, event driven strategy, macro strategy? So you could be asked those classifications in simple theoretical questions. Then comes event driven hedge funds. Now these guys, they, as the word suggests, are based on events. They look for events, and based on those events they take a position. The first in this category is merger arbitrage. You will buy the target company and you will sell the acquirer. So merger arbitrage means you're looking for a merger strategy. A merger strategy means whenever a corporate action is announced or a mergers and acquisition is announced, you would tend to buy the target company because target companies in general may benefit from an acquisition. Their stock prices tend to do well versus the acquirer. Acquirer is taking the risk. So there is a possibility that the acquirer stock price sees a downward tick. So if you are a merger arbitrage fund or a hedge fund, you will buy the target company and you will sell the acquirer. The other event that a lot of these hedge funds can look to is distressed or restructuring based investing, like assets such as SpiceJet, Go Air, Vodafone Idea, Yes Bank. These are typically securities or assets which you will say are distressed and they need some restructuring before they can turn around. Invest in bankrupt or almost bankrupt companies, and this strategy will focus then on turning around these companies largely. Then there is a activist strategy. Activist means you are looking at a shareholder activism. Here, the hedge fund is going to acquire significant equity investment in a company, and that significant equity investment will enable them to take certain decisions or influence company's decision in a way in which it turns out to be beneficial for them. So if you believe there is a very good company, but the decisions are not taken properly or decisions are destroying the value for shareholders, you can buy a significant chunk and then advocate for decisions which are pro shareholders, right? For example, capital distribution decisions, for example, mergers and acquisition driven decisions, and all of those decisions can eventually generate value from a company perspective. Finally, the fourth type of event, which event driven hedge funds will play for, are special situations. Other than M&A, this includes situations such as share issuances, asset sales. So a lot of times, buyback decisions, these are special situations, right? Where you would like to invest and benefit from a corporate restructuring or a corporate action. Spin-offs, mergers, demergers. A lot of people evaluate these options, and based on these options, they try and take a decision whether we would like to invest or not. So a hedge fund can take an equity hedge strategy or can be a event driven hedge fund. Then comes the relative value strategy. Relative value, always remember, is between two different types of instruments. It's relative value. A simplest example is fixed income convertible arbitrage, which means you are going to exploit mispricing between a convertible bond and its components, bond plus option. Okay. How are you going to do this? Theoretically, let me explain. Let's say you have invested in a company and you have offered them a loan, right? You've given them a debt. Now you have got a convertible bond because you have invested in the company. The company has given you a convertible bond. So your investment is, let's say, $100,000. Now that $100,000 is a bond instrument, right? So let's put it here in terms of numbers. So you have invested into a company with a convertible bond, and this is your investment. Or you believe you want to make this investment, right? And you have asked for a conversion price of $25 per bond. Now, why do you want to make this investment? Because you want to exploit the mispricing between convertible bond and its instruments, right? So it says this exploits mispricing between a convertible bond and its components. which is bond plus option to convert into shares. You know the share price currently, for example, is trading at $30 per share. So you want to exploit this mispricing. You will ask the company that I'm going to give you $100,000 today, but I want a conversion price of $25, which means I will convert it into number of shares post issuances, and I will convert this into 4,000 shares, bond divided by price, and then I'm going to sell these number of shares to get a payoff of $1,20,000. So this is mispricing, that the convertible bond is available at $100,000 and this. If I buy this bond and if I convert it into number of shares and if I multiply by the number of shares, I'll make $120,000, which means my return would be straight away 20%. This is a mispricing where you have a bond and you have an option. The value of the bond plus option is $120,000 versus the value of the bond, which is only $100,000. So you are exploring this mispricing. Bond is valued at $100,000, but the bond plus an option to convert into equity is $120,000. Because there is a difference in the two instruments, there is a profit opportunity available. And I would like to exploit this profit opportunity as an arbitrage opportunity. So funds will keep doing this mathematics for themselves across a lot of different instruments available in the market and see where is a mispricing between a convertible bond and its components and exploit this mispricing. Similarly, there could be a fixed income asset-backed strategy where you look at mispricing between asset-backed securities or mortgage-backed securities. Very similar, right? The only point is now the security changes. Rather than a plain vanilla bond or a convertible bond, you are looking at more complex securities or asset-backed securities, mortgage-backed securities. Have you covered fixed income for your batches? Fixed income is done. You've covered asset-backed securities, mortgage-backed securities. Or fixed income is still pending as a topic? Oh, it's still pending. Okay, not a problem. Anyways, you have a full chapter available in fixed income, which talks about asset-backed securities and mortgage-backed securities. So you should have a bit more clarification when you do that. So within this relative value strategy, therefore comes these arbitrage strategies. You have fixed income general, where explore relative mispricings between fixed income securities, 1 year bond versus 3 year bond versus 2 years bond. What is the mispricing available? You can use volatility as a concept to make money, use options to go long or short on market volatility, or multi-strategy where you're open for investment approach opportunities across asset classes. So this could be, merger arbitrage, this could be convertible arbitrage, could be fixed income arbitrage, could be anything, right? So there is no fixed strategy under a multi-strategy category. Finally, there is a macro strategy where you use top-down approach based on macroeconomic trends. Remember, the equity strategy was bottom-up. The macro strategy is top-down. You are starting from economy and you are going to industry and company analysis. Again, based on the macro approach, you take positions into fixed income, equities, currencies, or commodities, or any other asset class. For example, if you believe that the macro environment is shaping up for interest rates cut in the coming future, then you may want to load your portfolio with a lot of bond instruments, because bonds may then do relatively better as compared to equity. Equity also does well when interest rates cut happen, so you can plan your portfolio accordingly. So hedge funds in short will cover these 4 types of strategies for us. Benefits of investing in hedge funds and the risk which comes along with it. Like all other traditional asset classes, they are low correlation with other asset classes, which gives you diversification benefits. Generate absolute returns. So bull or bear market, they have to generate an absolute return, 10%, 15%, 20%, whatever that number is. Could provide market liquidity. Yes, hedge funds may provide you market liquidity. When we say market liquidity, hedge funds, because they are part of the market, they are buying and selling securities or investing in different securities, they can act as a counterparty and offer market liquidity. They are considered as arbitrage players. They are largely looking at arbitrage as an opportunity, risk-free profits. Risks, correlation has a major problem, or rather diversification has a major problem here. When we say we need diversification to reduce our risk, we need diversification to balance out our risk in bad times. The problem with diversification is diversification does not work when you need it the most. Diversification tends to fail in a market mayhem. So during financial crisis or during the phases where markets are not doing good, in such an environment, in general, what happens is diversification tends to reduce. The correlation tends to increase. And that is across asset classes. That is not only for that is not only for alternative investment, that is also for traditional asset classes. That it may fail when you look at from an overall perspective under a market mayhem or a financial crisis angle. Comparison is difficult as different funds follow different strategies. Like mutual funds, you cannot compare an equity mutual fund to a debt mutual fund. You cannot compare a hybrid mutual fund to a equity mutual fund. Similarly, in hedge funds, you cannot compare them across the categories because they are very, very diverse. Equity hedge funds are very different than micro driven hedge funds, and are again different as compared to funds such as relative value funds. Next on alternative investments are private equity, PE, which also encapsulates a lot of venture capital investing, investing in terms of development capital, which a lot of startups need. When we say private equities also bring in structures which are similar to hedge funds. It involves investing in private or public companies that intend to go private. So either the startup or either the company is privately held, can be a startup, can be a relatively big company, right? It's not necessary that private capital always invest into startups. Private capital may also invest into companies which are large, established companies, but are not public. It's absolutely possible. Example, private capital invest in across a lot of businesses that we see around us. Right? For example, Boat. It's a fairly good brand established in the Indian markets. And you could see private capital investing into a company like Boat, which is not public. But they may also invest into companies which intend to go public, because in that way they will make money when the company goes for an initial public offer. With the change in business conditions and availability of financing, the focus of private equity firms may change. A firm may manage number of private equity funds, and each composed of several investments. And the investee company, therefore, is called a portfolio company, as it will become part of a private equity fund portfolio. So private capital can invest into large companies, unlisted, into small startups. They could have multiple funds, and each fund can invest into multiple companies. All those companies in which private capital is invested are called as portfolio companies for a fund. The strategies on which private equities operate, first and very widely talked about, is LBO, leverage buyouts, where acquisition of private or public companies with a large part of your purchase price financed through debt. They are called as leverage buyout. The reason for them being called as leverage buyout, you are buying out a business, whether public or private, by taking a lot of debt, leverage. And that is why these are called as LBOs. We'll talk about it in a while in detail. Then there could be second strategy, which is venture capital investing. Now, when we say PE, we are so accustomed to talking PE and VC together, right? We always say private equity, venture capital investment. We treat them as synonyms. The problem is venture capital is a style of private equity investing. Venture capital in general is investment in private companies with high growth potential. And most of these investments happen at nascent stage, very, very early stage investing. Development capital, on the other hand, private equities can offer development capital, which is investment in relatively mature companies for further expansion. Or you could have distressed investing like hedge funds, where a private equity will invest into an asset which is in a distress mode. And the idea is to bring the asset out of that distress mode and make supernormal returns. Talk about each of them in detail. LBOs. LBOs are sometimes also referred to as going private transaction, where you do an LBO or a leverage buyout and then take a public company private. I think one of the most talked about LBO deals was Dell. Dell, which was a listed company in United States, the laptop manufacturer, owned by Michael Dell, was taken private after an acquisition by a private equity company. So some private equity companies may take companies private. The reasons being, they don't want public market scrutiny. They don't want a lot of public market based filings and bandwidth of management being consumed in conferences and analyst calls, etc. They want to run a business which is privately held with less amount of disclosures and things to be put in the public domain. So LBOs can be done to take companies private. Along with LBOs, there are MBOs and MBIs, management buyouts and management buy-ins. Management buyout means the current management looks to acquire the business. Now, management may want to acquire the business. The problem is management sometimes falls short of capital, right? For example, Jet Airways. When Jet Airways was going through the turmoil phase, the management of Jet Airways, the CEO and the top management said, we want to acquire the business and we want to run this business. The promoter has done it is a promoter issue. The promoter can be changed, but we would like to acquire the business and run the business. The only problem is in management buyouts, the management sometimes lacks the financial capital to execute a management buyout. But in theory, the concept does exist. Management buy-in, where the current management is replaced and the company is acquired. What makes LBOs stand out is significant use of debt to magnify equity returns. Yes, if you're going to use a lot of leverage, this brings in a lot of risk. But along with a lot of risk, there is also a possibility of supernormal returns. So equity returns can be magnified. Equity losses will also magnify if things go wrong. For LBOs or within LBOs, you will also read a term called as mezzanine financing, providing finance to help the company go public. So whenever companies want to go public, they don't want to go for an IPO with a very weak balance sheet. They would tend to go public with some amount of cash on the balance sheet, which shows their financial strength. Therefore, before any IPO, a lot of companies go for a mezzanine financing. Some of them look at anchor investors. Some of them look at private equity investors who would be happy to invest into the business before an IPO. And this mezzanine financing provides finance to the company to help the company go public. What are the characteristics then for an attractive target company for LBO? These are typically undervalued or depressed stocks. You're looking at companies which are undervalued, companies uh, which have a good business model, but which are going through a bad phase from an operational perspective. Willing management and shareholder. These are inefficient companies. Remember, these are companies which have good business models, but these are run inefficiently. You want to acquire such businesses, and then you want to turn around these businesses in order to make returns. Inefficient companies with strong and sustainable cash flows, which could help in interest payments. If we are looking at, let's say, if we are looking at LBO, leverage buyout, you want to buy only those companies which have good cash flows. Because once you take debt, once you take loans to buy a business, you will also have to service that loan. And servicing the loan will require cash flows. So you would like to always take this into consideration that, do I have a company which has strong cash flows? If I try and bring in efficiencies into the business, will those efficiencies enable higher cash flows in servicing of the debt? Low level of existing leverage. Now, you don't want to buy a company where the existing leverage itself is very high. Because if existing leverage is high, then you have a problem that you cannot take a lot of debt, because you're already looking at a very stressed balance sheet. And if you take more debt on top of it, it's a problem. Significant amount of physical assets makes it easier to get a secured debt. If you're going to borrow money, you will obviously require collateral. And that amount of collateral, or that the higher the amount of collateral, better it becomes from a leverage buyout perspective. So these are the typical characteristics that you will find in a leverage buyout. From a venture capital perspective, second strategy, the target company is known as portfolio company, as it will eventually become part of fund's portfolio. The target could be a VC in any stage from inception to initial public offer, right? So the investment could come in any stage, from a very nascent stage company to an IPO stage business. Investors demand a very high rate of return, and earlier the stage of development, higher the risk. The simple rule is, if you are investing into a nascent stage company, right, which is, let's say, a 1 or 2 year old startup, your return requirements are northwards of 60-70% on a per year basis. Reason? The risk is very high and you would commensurately want higher returns. As the company grows in size, the risk reduces, and therefore the return expectations are also reducing with every lower with the lower amount of risk, right? So if someone says put money into Zomato 10 years ago, risk was very high, returns could be very high, losses could also be very high. Today the risk is a bit relatively lower, and therefore the returns that may be generated will also be relatively lower. The best way to understand that is with respect to numbers. Zomato's investment, or investment into Zomato by Naukri.com, was of levels sub 5 rupees. I think if I remember correctly, Naukri.com or Info Edge Sanjeev Bikhchandani's investment into Zomato is 1 rupee or 2 rupee per share because he was the early investors into Zomato. So today he's looking at a return which is 200 times versus IPO investors who invested at 70 to 76 rupees. Their return is, let's say, 2.5 times versus someone who invests now, the returns could be relatively lower. So as the risk reduces, the returns also commensurately reduce. Venture capitalists generally actively manage the portfolio company. So this is one part of private equity venture capital investing, where venture capitals are active investors, which means they take part in companies' day-to-day operations to make it better and make it more efficient. VCs usually get equity of portfolio companies, although they also provide debt financing. In some cases, you will also see them providing debt financing or venture debt financing. Financing in formative stage, angel investing or pre-seed capital. This is the capital provided at the idea stage, which is called as the inception stage. Very high risk. Seed stage. This stage pertains to providing capital to fund research and development for new ideas. Then comes early stage investing. This includes startup financing or the first stage financing. Initially, as the company progresses in its development, gradually product development to fund initial marketing, you need funds. To start commercial production and sale of products, you need again funds. So your development of the company is moving forward. Along with each phase, you need finance. From early stage, then you go towards the later stage of financing. Second stage investing, enable a company to carry forward production and sales. And finally, you need a third stage financing to fund major expansions of the company. For mezzanine or bridge financing, timing is anytime after the inception but before IPO, so that you can have a bridge to get to the IPO. So private equity can invest in any of these phases, from angel to seed to early stage to mezzanine. It all depends on how much risk the fund is ready to take. It's a private equity fund's risk profile that determines whether you're going to take early stage investing or you're going to take up mezzanine investing or somewhere in between. Private equities also look at minority equity investing from a development capital perspective. This is usually done by private companies that want to sell a portion of shares before an IPO. Although this is generally for private companies, sometimes this is private investment in public equities. Private equity not only invest into privately held businesses, they also invest into public companies. Like in idea, we have in India, perhaps we have a company or mid-cap IT company called Coforge. Coforge was earlier known as NIIT Technologies, right? NIIT has two divisions, and some of you obviously know them. NIIT Limited uh, is the training arm which offers those computer courses, etc. And they had a technology company, which is NIIT Technology, which is a software company now called as Coforge. So Coforge was owned by Bearings, and Bearings is a private equity firm. Bearings eventually sold their entire stake in the company, I think last year or last to last year. So when they invested into Coforge, Coforge was a listed company. So private equity also invest into listed companies or public equities, and that is called as private investing into public equities. Distress investing, also referred to as vulture investing. Why vulture investing? You are almost eating the dead. These companies are mostly dead companies. They have nothing left over, but you would like to turn them around. So they are securities of companies that have filed or are close to filing for a bankruptcy, which are seeking out of the court debt restructuring to avoid bankruptcy. The possibility of turning around these companies is relatively low. That said, there is a remote chance of turning around these businesses. So some private equity companies or private equity players may want to invest into these. These are all private equity strategies, keeping in mind they would like to find an exit. Now, this is important. When private equities invest, it is not only it's not from a very long term perspective, right? Private equities just don't invest because they have capital. They also plan an exit. When we say they plan an exit, they look at a planned exit from a company. This planned exit may include a trade sale to begin with. And these are all options. What you see on your screens are all options in terms of exit for private equity. When you put money into a business, you want to exit from that business and make your returns. First is trade sale, where you sell your company to a competitor or another strategic investor. So a lot of private equity players can do this. Like the example of Coforge, Bearings bought it, and now Bearings have sold their entire stake in Coforge to the open market. In the public market, they have sold their stake and they have exited the company. So they made their profit on a company like Coforge. Their strategy was secondary market sale. Then comes IPO. Some of these players go and take the company public, list it on the bourses, list it on the exchanges. And once you list it on the exchange, you can exit. So there is a possibility that you can exit it through an IPO. Carlyle, for example, was one large player or one investor into SBI cards. What did they do? They took SBI card public and they exited their stake gradually from SBI cards. So IPO is one way to encash your investments, take the company public, sell your shares, which is called as an OFS, offer for sale, and you can make your returns. That is a way of exiting the business. Then some private equity players may also look at recapitalization. Recapitalization may not be classified as a traditional exit strategy, but in a way it helps you get exit. Let's say if I have invested in your company, I will ask the company to take a lot of debt, use leverage, and based on that leverage, I would ask them to give me dividends, right? So take debt and pay dividends. As soon as you take debt and you pay dividends, I have made some money. I have extracted some funds out of the business. I have recapitalized the business. The business earlier was 100% equity business, no debt. Now the business has debt and you have made me some payments using that debt, which has offered me some returns. So it's a way of getting returns for yourself. Secondary market sale. If none of these work, so look at a secondary market sale. Quite frequent from one private equity firm to another, right? Basically, sell your stake to another private equity firm and you can exit. Possible. A lot of times it happens where you can sell your stake to someone else who's ready to buy it and you get an exit from the business. Last one, technically, this is also an exit. A lot of us don't think about it top of the mind, but technically, this is a form of exit, which is called as a liquidation exit, a write off scenario. When the firm is no longer viable and the transaction has not gone well, then you can liquidate the firm. You can shut down the company. Shutting down the business, liquidating the firm is as good as an exit. The point is, you are getting an exit from the business, but you are getting it at a fairly low valuation. But you are getting out of the company, and getting out of the company is an exit. So all of them are types of exits. It is up to the private equity firm to decide what gives them a better valuation, what gives them a better exit. Obviously, the favored options here or the most preferred options here are IPOs or mergers and acquisitions, which is sale of the business. The least favored option or least preferred option is obviously liquidation. You don't want to shut down the business or file the business from a liquidation perspective. Now, in private equity, you could also see private debt investing. It's relatively lesser as compared to equity investing, which is why we hear the word private equity a lot and not private debt a lot. But debt does exist from that perspective. Direct lending, the private debt investors provide capital to the borrowers and subsequently receive interest. The original principal amount and any other payment associated with the lending is a direct lend. Let's a traditional lending arrangement. You have given a loan. In direct lending, firms also provide debt in the form of leverage loans, which is a loan that is itself levered, where they have also taken a loan, right? So when we say leverage loans, private debt firms borrow money and then give this money to another company. How will they benefit? Leverage loans means private equity company is going to borrow money, let's say at a 4% interest rate, and give it at 8% to a portfolio company. For them, the return is the incremental 4%. This can offer you that additional 4% return that you're looking at on debt. So these are called leverage loans because the private equity company itself is borrowing money, and based on the amount of money that they borrow, they are further lending it to their portfolio companies. The benefit for private equity firms or private debt firms is they can get debt at a cheaper rate in the market. So for them, it is generally one way of doing or making an investment, and based on that investment, get additional returns. Mezzanine debt. In case of private debt, mezzanine debt is a form of private credit that is subordinated to the senior debt, but is senior to equity. So in capital structure, you are senior, but within the debt structures, there is a senior junior relationship that you are looking at. So from a mezzanine debt perspective, in capital structure, you are senior to equity, but you are junior to subordinate or senior secured debt. It makes a pool of additional capital available to borrowers beyond the debt that is typically used to finance LBOs, recapitalizations, or acquisitions and similar transactions. You can offer a mezzanine debt, and as we have talked about earlier, mezzanine debt is more from a equity or more from a IPO perspective. Then comes venture debt. Private debt funding provided to startups or early stage companies with venture capital backing that may be generating little or negative cash flows. This is in general provided to very, very early stage businesses, and the objective of offering this is largely to ensure that the business goes to the next stage. The business does not wind down on a specific cash issue, right? So you just want to offer them some more leeway or some more runway in terms of cash financing. Distressed debt typically involves buying debt of mature companies with financial difficulty investors tend to look for companies with temporary cash flow problems but good business plan. So you are only going to invest into a distressed asset if you think the business is good. The problem is short-term cash issue, but the business is good. Why are there so many people who are lining up to buy airlines? Right? Why are people still talking about someone going to buy out Jet Airways or infuse capital into SpiceJet or Go Air? The problem is a lot of, or the issue or the way people look at it is a lot of people believe aviation has a lot of potential in a country like India. What happened with SpiceJet or what is happening with Go Air or with Jet Airways is more company specific issues where companies were not run properly. So they are not betting on the company. They are saying we can resolve these issues, but we can only resolve it if the underlying sector or the business is doing is favorable, which they believe is, and that is why they are trying to buy this debt out from banks, give banks an exit, give them whatever money the bank and can negotiate out of them, and then turn around the business. Other private debt strategies: investments in or issuance of collateralized loan obligations, where these being leveraged structured vehicles collateralized by a portfolio of loans covering various range of tranches, issuers, and industries. So asset-backed securities, mortgage-backed securities, collateralized loan obligations, these are all securitization. This is all what we have in general seen as part of the 2008-2009 subprime crisis. This is all something that obviously your fixed income book would cover, but that is one strategy where you can issue CLOs or collateralized loan obligations, which are nothing but pooled loans or loans pulled together and sold into tranches, which again private equities or private debt can be subjected to. Another debt is unitranche debt consisting of a hybrid or blended loan structure combining different tranches of secured and unsecured debt into a single loan with a single blended interest rates. Now, in finance, one thing for all of us to remember, you can design a financial instrument the way you want. There are all types of customized instruments, structured products available in the market. And when you read these instruments, they are all customized. Please remember, they are all customized for the requirement of what the client wants, right? So companies like BNY Mellon offer a lot of structured, Standard Chartered offers a lot of structured products in the Indian market, and those all products are designed from the perspective of what the client wants. So you can have a unitranche debt where you pool in secured and unsecured and then issue a security. This benefits and risk of investing via private equity or in private equity. One, it provides once again higher yielding opportunities to fixed income investors seeking increased returns. But please remember, with a very high risk environment that we are looking at here, returns are higher, risk is also high. A lot of startups fail, right? A lot of startups do not even make it to Series B round of funding, right? So there is a possibility. There is a possibility that some of these startups don't even go to Series B round of funding, which is the risk the investor is ready to take. But for companies which eventually end up becoming big, it offers you higher returns, right? So if you have invested into startups and if those startups eventually go and become billion-dollar companies, your returns are fairly large. Like as I said, 200 times returns for Sanjeev Bikhchandani on his investments into Zomato. Investors in private debt could realize higher returns from the illiquidity premium. Illiquidity premium means you cannot exit a lot of these investments at will, right? The problem with a lot of these investments are you cannot exit these investments whenever you want. Why is that the case? They are illiquid in nature. They are not listed in general. They are Some of these investments are illiquid in nature. Risks potential for higher returns is connected to higher level of risk, and other risks such as illiquidity and heightened default risk when loans are extended to riskier entities or borrowers in riskier situations. But we all come and we all are aware about these types of problems. We are aware about the issues or the risk we are taking when we are investing into startups or into early stage businesses. From a private equity perspective, diversification benefits. Better returns through influence on portfolio companies because you're taking active investing, because you're using leverage, and by active investing you are influencing the companies. This is going to benefit the businesses. There could be operational turnaround in the business. A lot of times private equity players bring in sector expertise, right? So if I'm going to invest into your company, the company can get a lot of sector expertise from the investor itself. The investor connects them to resources. All that translates into better performance for the business. Risk, like private debt, historical data may suffer from survivorship bias and backfill bias. Now, what is survivorship bias? Survivorship bias means you are only looking at data for players who have survived in this market. You are not looking at data for players who have collapsed or who have shut down their business in this market. Right? So you're only looking at survivors. And if you're only looking at survivors, then you are looking at a bias in which there are only positive data points. These positive data points can distort your analysis and can only offer you, the goods of the data points, which may not be an appropriate way to look at the data. Survivorship bias means only players who have survived have offered you the numbers in terms of what they have made it as returns, and you don't have any negative data points because people who have not survived are not even giving you those data points. So in general, survivorship bias is an upward bias. You're only looking at positive survivors and there are no negative data points, which means whenever you do, for example, an average calculation, your average will not reflect the true picture. It will always show you a higher number, but in reality, the average may be a bit lower. Illiquidity risk does remain in the system. Illiquidity risk is always there. You don't know when the companies go public, and if they go public, you are not sure the timing and the returns which they are going to receive. Questions around private equities, hedge funds? Actually, perfect. Then let's look at one more. Let me know whenever you need a break. We'll have, I think, one break additional for you. Today the session is, I think, till not 9 to 2. I think I was reminded 9 to 1. The session is 9 to 1. So let me know whenever you need a break. The intention is to cover natural resources and possibly infrastructure today. For digital assets, we will meet tomorrow and we'll take digital assets with any questions that we will have to work through. Let's pick up natural resources and let's say post natural resources, we'll take that break for you, not a problem. Now, when we say natural resources, one asset class which sees very, very active participation from investor fraternity. and especially large investors, sovereign investors, a unique asset category comprising commodities, raw land used for farming, and timber, right? So land as an asset class is something which a lot of people cater to, or a lot of people look at from an investment perspective. It also includes real estate assets, and infrastructure can also include inflation protected securities and other investments formed to protect against an increase in consumer prices. Natural resources may include commodities, and commodities can further be bifurcated into uh, agri commodities, energy based commodities. You have bullion as a commodity, so you can pick up commodities on all of those scales. Commodities, these are physical products that is capable of being standardized on quality, location, and delivery for the purpose of investing. The return on such an asset is based on change in price rather than income from interest, dividends, or rental. Right? So you don't get any income from interest, dividends, or rentals in commodity investing. You're largely looking at capital appreciation. Holding the commodities also include incurring transportation and storage cost. Yes, if you're holding the physical commodities, one thing that comes top of the list is storage cost, along with obviously a lot of transportation related cost. A few sector-wise examples include energy, commodities like oil and natural gas, big markets, especially for oil, base metals like copper, aluminum, precious metals like gold, silver, agriculture, livestock, etc. All of this is commodity, and their commodity markets are one large part of investing fraternity. Timberland and farmland offer an income stream based on sale of trees, wood, and other timber products, and has not been correlated with other asset classes, while farmland is seen as a provider hedge against inflation. Now, remember, from a US market perspective, timber and farm are two big investment objectives for a lot of people. Just like timberland, the farmland prices or income component related to harvest quantity and agriculture commodity prices are dependent on these two variables. But from a natural resource perspective, this is an investment avenue which is available to a lot of investors. Benefits from a natural resource perspective, and we have talked about this at the start of our class, like gold is one of the perfect hedge in a falling equity environment or in a high risk environment. Geopolitical tensions, gold is one of the best bets to invest into. That's exactly what you have seen for gold. uh, from last year same time to this, we are up from 60 to 72,000. From 2022 May to 2024 May, we are up from 50 to 72,000 on gold, uh, which is a 40% return in 2 years on gold. Exceptionally good. The only problem is gold behaves in a sporadic manner. Gold does not move for 2, 3, 4 years, keeps hovering around a specific benchmark, and suddenly moves in 1 or 2 years uh, to a level which is higher than where you are at present. So I think that is where gold or other asset classes like commodities benefit. Today, gold maybe at 72, possibility gold doesn't do it, has nothing to do over the next year or 2 years, and then suddenly the gold shoots up to 85, 90 threshold, because the moves are generally sporadic in gold, and gold gives you easily a 20% move on an yearly basis the year it decides to move. So that is what makes commodities uh, as an asset class very interesting and generally part of portfolios. Potential for returns, portfolio diversification, and inflation protection when you are investing into commodities. Farmland has highest annualized return, and timber has the highest standard deviation for a very long time in the market. Risk, commodity investments, when combined with leverage, exhibit high volatility, leading to many well publicized losses among commodity traders. So I don't know whether you remember or not, but during the COVID lockdowns or crisis, commodities went, or rather specifically a commodity like crude, went into negative, right? So commodity futures or crude futures were trading at a negative price, minus I think $36, if I remember that correctly. Minus $36 meant someone was ready to give you a barrel of crude oil for and $36 if you take the crude oil away from them. The problem was there was so much inventory and there was no offtake. There was no storage place available. So a lot of suppliers were ready to give away the crude, that take this away from us so that we don't have to store it, because the storage was more expensive than $36 per barrel. So they said, we are happy paying you $36 and you should take this barrel of oil from us, because if we have to store it, we will have to spend more than $36 per barrel. So rather than that, pick it up from us and take it away from here. So commodities are exhibiting very high volatility in uncertain environments, and that could lead to very large losses. And some of them are very well publicized uh, in the public, in the domain, financial domain. For some of these, liquidity is very low and the risk of negative cash flows is high, as the fixed costs are really high and revenue varies based on the weather conditions, right? So commodities are subjected to weather conditions. The risk of storing them, the risk of seeing a price deterioration is a real time risk, and that can lead to heavy losses on the commodity bucket. Perfect. Questions, concerns, anything? Okay. Actually, if nothing else, the last break for the day for you then, 15 odd minutes. It's 11:15 my clock, so 11:30 is when we'll begin, and then we'll add two more asset classes to our discussion possibly today. Uh, I think real estate and infrastructure. Yes, I think we'll try and cover real estate at least, and we'll see if we can cover infrastructure, and then we'll take the remaining part for tomorrow's session. So take a break, 15 odd minutes, and we will pick it up at 11:30. Surely, perfect. Let's start from real estate then. So next on the alternative asset list or alternative asset category is real estate. Now, real estate as an asset class is something that a lot of us are pretty comfortable because a lot of us have actually been around real estate. We keep listening about real estate. So this is something which does strike a chord earlier than a lot of other asset classes. Benefits of real estate investing are top of the list: long-term returns comprising capital appreciation. Along with capital appreciation, regular income generation asset, right? So rental incomes or lease incomes are something which a lot of people look forward to. Limited cash flow impact from shocks in broader economy, particularly in case of multi-year leases. So if especially you talk about commercial real estate would have long-term leases signed with tenants, and even if there are some shocks or some cool down in economy, they are generally not impacted that much because of these long-term lease arrangements. In a very uh, you know black swan event scenario, they may see at best negotiations on the rents, but again there are certain amounts of income which is almost guaranteed to them. Real estate investments offer less than perfect correlation with other asset classes, which means low correlation with other asset classes, and therefore low correlations transpire into higher benefit or higher diversification benefits. Real estates are considered to be one of the best hedges against inflation. With inflation, the real estate prices tend to increase to a large extent. So they offer a reasonably good hedge against inflation. The only caveat and only point of debate which has been around real estate, especially in an emerging economy like India, is the yields. When a lot of people say, I want to invest into a real estate property because I may be able to generate rental income or lease income out of the property, the income divided by the price of the property, that ratio, which is called as rental yield, is abysmally low across a lot of cities. The more expensive the city real estate is, the lesser is the yield on that real estate. So the yields are ranging anywhere between 2% to 3%, or at best 3.5%, which is very low in terms of the amount of investment required to buy a real estate property. That said, the counter argument which a lot of people will throw is capital appreciation, that I've purchased a property and the property, especially from a residential property perspective, or a commercial property perspective, that the property has increased in value. There is a capital appreciation on the property that I've purchased. That is fine. There is a capital appreciation, but that capital appreciation is largely on a piece of paper. Until and unless you are able to sell the property at that rate, it is all on a piece of paper. And the challenge in terms of selling a lot of real estate properties is the abundance of properties or the supply which is available, right? Take an example: cities like Pune, Mumbai, Delhi, Hyderabad, Bangalore, which are your top tier one cities. There's a lot of supply, and until and unless you have a property which is sitting in the core, areas of the town, outskirts, which is where a lot of development is happening, if a lot of people are investing there, selling them may be a bit difficult because there are so many new properties available that any buyer would first look at the newer available options. So it all looks good on a piece of paper. There's a capital appreciation, there is a rental that you are actually getting, but the yields are abysmally low, given the price at which a lot of these are selling. That said, we are more catering towards the US market. US market, the yields are much better as compared to what Indian markets are. Surprisingly, you will find a lot of US market, the real estate properties are much cheaper than buying them in India, from a price perspective. Characteristics: return generated through rental income and capital gains, provide diversification benefits, acts as an inflation hedge. These properties are not divisible and hence they require large investments. The upfront investment in real estate properties is commensurately large. You have to look at a long-term horizon. If you are investing into real estate, look at high transaction cost. Properties are immovable and unique in nature. No property can exactly be compared to another property. They have some distinct features. These properties can be illiquid in nature, and real estate market itself can be inefficient, which means information may not be easily available. The amount of transparency is relatively less even in a real estate market. Most of these real estate investment characteristics are fairly known to all of us. In general, there's nothing too different between Indian market versus US market, so you can more or less map it on a one-on-one basis between India and US. Now, the way or the forms in which one can make an investment into real estate. Real estate investments can be divided into four sections. You can make a private investment or a public investment, and you can make an investment into debt and equity. And all four of them can be used to create four different quadrants from an investment perspective. Private, which means a single owner or lender, or public means multiple buyer sellers market, and equity ownership or debt lending investments. From a private debt market perspective, you can invest into mortgages, construction loans, and mezzanine debt. So, as a single owner or as a single lender, basically you can offer home loans, construction loans, mezzanine debt, and participate in the real estate market. If the real estate market grows, along with that, your loan agreements will be honored and you will be made a commensurate interest payment per se. From a private equity market perspective, direct ownership of real estate, where you own through sole ownership, joint ventures, separate accounts, or real estate limited partnerships. You can go ahead and directly buy private market equity. But you can also do indirect ownership via real estate funds or REITs. Right nowadays, you can also buy properties through REITs, or you can participate in the real estate market through REITs, which is real estate investment trust. In this indirect ownership, the amount of investment is lowered significantly. For example, if you want to invest into a REIT, you can invest into a REIT for fairly low ticket size versus direct ownership of real estate, where you will have to put in a large amount of investment. From a public debt perspective, debt instruments will include all your securitized assets like mortgage backed securities, MBS, whether you are looking at a residential mortgage backed security, RMBS, or a commercial mortgage backed security, CMBS. Collateralized mortgage obligations are again securitized assets, mortgage REITs or ETFs that own mortgage debt. So in public market, listed market, you might have a lot of these securities available. From a public equity, you can go and buy shares of real estate companies, right? So you are bullish on, let's say, the real estate market in the NCR region, you can go and buy the security or buy the stock of DLF. DLF is the largest player perhaps in the NCR region, and if real estate does well, DLF share price will effectively tell you that. Listed REIT shares, mutual funds again, and again you could have private REITs, you could have listed REITs, public REITs basically. Like in Indian markets also, we have public REITs. We have three REITs I think listed: Embassy, Mindspace, and there's one more which is listed. But in US, the REIT market is very large, right? The number of REITs listed in US are significantly more than what we have in India. So public REITs or listed REITs you can buy. Mutual funds, index funds, or ETFs are all a way to get into publicly traded securities. So as an investor, we need to decide that is it a private investment or a public investment, and is it an equity investment or a debt investment, to get an exposure to real estate as a market. End of the day, you need an exposure to real estate as a market. The benefit of direct real estate investment, like So the benefit of a direct real estate investment, direct ownership of real estate, will typically arise from, one, control. You own the property, you can control the property, you can decide when to buy, when to sell. Very similar to direct investing in alternative assets where we started our session with. Tax benefits, obviously the owners get tax benefits if they buy direct real estate properties. Some of them are tax deductible in terms of expenses, and you also get diversification benefits, which we have obviously talked about. The only complexity in investing early in a property is, one, you will need capital, right? And everything that you believe is a challenge from a real estate investment perspective comes here, right? Capital. You need to have significant amount of knowledge to understand real estate as a market. There are negotiations, due diligence. You need to be very sure about the title of the property itself. All of that is makes direct real estate investing tad riskier. Couple that with illiquidity. As soon as you buy a real estate property, you are looking at an illiquid asset, right? You may take time to sell that asset. Now, a lot of people also have an opinion that real estate can be sold quickly. They come back and tell me, okay, I can sell the real estate quickly if I lower the price. The issue is that is not liquidity, right? So what does liquidity means? Liquidity means if you have a property which is fair value at, let's say, $1 million, the fair value of the property is $1 million. You cannot come and tell me that I sold it for $500,000 and I got liquidity. $500,000 is liquidity. It is liquidity at a very, very deep discount, right? So that is a loss for you, right? You have basically paid 50% to get just some liquidity, right? So liquidity, generally, when we say normal environment, liquidity at fair market value or liquidity at fair prices is what we are looking at. From an indirect investment perspective, some of these disadvantages are taken away. From an indirect investment perspective, let's say, for example, if you are going to invest into shares or REITs, you get some benefits, which means lower ticket size of investment. Especially, for example, in REITs, you also get an investment manager, a professional investment manager who's going to manage the REIT. There is a trust structure which is established, right? This is typically, private REITs are more risky or not risky. The point is, private REITs are not listed. That is the only significant difference between a private and a public REIT. Private REITs are not listed, so illiquidity is the only major risk. Apart from that, there are no problems with private REITs also. They're pretty much the same, but they may have a lock-in for you. So illiquidity as a challenge does exist. I think that there are no major risk factors. REITs, for example, are fairly stable instruments. For example, they have a standard regime that 90% of dividends have to be distributed to the unit holders, right? So the amount of money that they are going to get is also more or less fixed because they have long-term arrangements or lease arrangements with the tenants. What they have to pay to their investors is also more or less decided. The only thing with a private and a public REIT is liquidity. Private REITs you are not able to sell at your will. Public REITs you can sell any day the stock market is functional or operating. It's very easy to get out of a public REIT. Now, from a real estate investment perspective, the forms of real estate, residential property obviously is one big category of real estate investments. The one interesting aspect is, in India, we don't classify real estate or residential real estate into multiple buckets, right? For us, residential real estates are only of two types largely. One, either you're living in a bungalow or you're living in a flat, right? So those are the two broad ways in which real estate or residential real estate is looked in India. But US has several different types of residential properties. They have apartments, they have single family homes, they have multi-family homes, then they have condominiums, they have townhomes, There are a lot of them, right? Easily, I think 7, 8 different types of categories of residential real estate properties listings. So direct equity investments are generally leveraged. Like in India, you have to obviously buy a home, you need some amount of leverage or loans, financed through a mortgage. Lender could pool the mortgage to form residential mortgage backed securities. So the lenders or banks can basically create an RMBS, a residential mortgage backed security, and sell these RMBS to generate liquidity for the bank. Lenders should, however, undertake due diligence to ensure that borrower has made enough equity contribution, right? When someone is going to buy a real estate property, it's the lender's prerogative to understand is enough uh, capital invested by the buyer. The buyer has a good credit score or a credit review. Like in India, we have a CIBIL. In US, they have something called as a FICO, FICO, FICO score. Equivalent of CIBIL, you can call it an equivalent of CIBIL, which is used to assess the credit score of the individuals there. And this is something which is important from a FICO score perspective. Again, it's very similar to CIBIL. As I said, it's again a 3-digit number which ranges, I think, from 300 to 800, 850, somewhere around that count. But yes. So this is the lender's job to find out what is the credibility of the borrower. Now, will the borrower be able to repay the money? Does he have enough source of cash flows, sufficient cash flows to make regular payments? Again, like typical banking in India works. And the estimated value of home and appropriate insurance around it. So residential properties are one large asset class on which a lot of people will bet and invest into. Then comes commercial properties, which generate rental income. A residential property bought to earn rentals is classified as commercials. Direct equity investors are generally rich individuals or institutions. While creditworthiness of the borrower is critical, as in case of residential properties, analysis of properties valuation and cash flow is also important. Now, you have to always remember in commercial properties, uh, the tenant profile is very, very important, right? What type of tenant do you have? If you have a commercial property and let's say if McDonald's is your tenant, you know it's a long-term arrangement, it's a very good brand, and eventually your cash flows are not at risk. You'll keep receiving certain amount of cash flows because the tenant profile is good. Uh, Tenant, or from a mediocre tenant perspective, there is a problem because if the tenants keep shifting, you will have to keep renegotiating the rents and you have to keep working around with it. That may not be suitable from the company perspective. Lender could pool the mortgages to form commercial mortgage-backed securities or CMBS. So like RMBS, this is residential mortgage-backed securities. CMBS are commercial mortgage-backed securities. Let me give you a quick brief. When I again and again say they pool, what do they mean by it? And obviously, your fixed income session should do justice to this topic. Let me give you an overview around it quickly. So the way this works, how do these securities get created? RMBS, CMBS. There is a standard bank, commercial bank. Commercial bank gives loans, right? Mortgage loans. It could be a residential mortgage, it could be a commercial mortgage. So the commercial or the bank basically gives loans to individuals to buy residential and commercial properties. Let's assume the bank has given loans worth $100 million. Now the bank is expecting all these loans to be repaid back to the bank over the next 10, 20, 30 years. But the bank says, I want immediate money. I want immediate liquidity. I cannot wait for 10, 20, 30 years. What can I do? I have given $100 million loans. I am expecting $150 million back by way of EMI payments. So let's do one thing. Let us sell $150 million of EMIs to someone else. So the bank takes that $150 million of number and sells it to any investor who is looking for a stable income over the next 10, 20, 30 years. So the bank says, okay, I found an investment bank, and the investment bank wants stable income for the next 10, 20, 30 years. So I'll tell the investment bank, I have $150 million of EMIs. I am pooling all my loans in this. Pooling loans means I'm just putting all the loans in this $150 million. I can sell it to you today for $130 million. If you give me $130 million today, I'm going to sell this to you today. And I get immediate liquidity as a bank. I get $130 million in my bank, and I can use this to lend more loans or provide more loans to people. The investor gets 130 million in $130 million. The investor gets an asset which is going to repay $150 million. So everyone is happy in this. The bank is happy. They got immediate liquidity. The investor is happy. They bought something worth 150 for 130. And over the next 10, 20, 30 years, they will make that additional $20 million. So in this case, we'll typically say that they have pooled the securities and they have created a bunch out of it, which is a mortgage-backed security. Okay. Then comes real estate investment trust. REITs issue shares that are publicly traded and listed on stock exchanges, right? So they are typically like shares, right? They are traded every day. REITs investments could be in the form of equity as well as debt. Different types of REITs are defined by the type of investments in real estate. So in general, what we have in India are only office REITs, right? So like Embassy is focused on the Bangalore market. Mindspace, which is listed, is focused on the Mumbai and the Pune market. But they're more commercial office-based REITs. In US, you'll also find REITs which are based on hotels, malls. So if you believe and if you want to participate in the growth of hotels as a sector, then you want to invest into real estate properties which are hotel properties. So you can pick up based on the type of real estate you believe will do well over the next few years. Most of the income for these REITs has to be distributed as per the regulatory requirements. They also provide tax exemption, and occupancy rates and rent amounts are key earning drivers. You want your properties to have a very high occupancy rate. You don't want properties to be vacant, because in real estate, vacant properties are generally a problem. MBS, as I explained, all those $130 million of securities which are sold to investment bankers or any other investor like a sovereign fund, pension fund, endowment fund, who can buy that $130 million of security, which are called as MBS. Those are all backed by a pool of loans with real estate properties as collateral, right? All the loans which people took and all the loans were backed by the properties as collaterals. They could be classified as RMBS or CMBS depending on whether the loan was home loans or commercial loans. And they can be issued publicly or privately. Private fund investing styles. Real estate private equity funds are structured as infinite life open-end funds that allow investors to contribute or redeem capital throughout the life of the fund. Open-end funds give you this option. You can redeem whenever you want. Open-end funds offer exposure to core real estate characterized by well-leased, high-quality institutional real estate in the best markets. Core plus strategy also accepts slightly higher risk derived from non-core markets and sectors with strictly more leasing risk. So sometimes you build a core portfolio and then you take smaller risks here and there to magnify the returns with the complete knowledge that you are taking higher risk. Finite life closed-end funds are more commonly used for alpha and beta generating value add and opportunistic investment style. So these are finite life. Finite life funds automatically means you are just trying to explore short-term opportunities available in the market. So a lot of people may look at a short term and say, okay, in the next few years, we will require investments into healthcare as a sector. So I'm just setting up a real estate fund which invests into healthcare for a very short term time frame, maybe the next 3 to 5 years, and then I think this opportunity will go away. Similarly, value add investments may require modest redevelopment or upgrades to earn higher return than core properties. Existing property offering reasonably good returns, but you believe that with a small amount of change and refurbishment and upgrade of the property where value add may happen, you can get a higher return. Along with this, opportunistic investing accepts the much higher risk of development, major redevelopment, repurposing of assets, taking on larger vacancies, and speculating on significant improvements. This is changing the entire property paradigm in itself. Right? Redevelopment is one classical example. You find an opportunity, you redevelop the asset, sell the asset, make a lot of money out of it, or you repurpose the asset. An asset which was designed for, let's say, healthcare is not used for healthcare anymore. So you can repurpose it and you can get a better return out of it. So sometimes these properties, heritage properties, for example, these were largely repurposed from hospitality perspective, and they make us fairly good set of return for the investors. So in these fund investing styles, the funds can pick up any of these styles, opportunistic or value or finite life or infinite life real estate funds. It depends on the geography, because real estate is very, very specific to geographic condition and the demographics around that specific geography. From a performance measurement perspective, there are 3 ways to measure performance: appraisal based index, repeat sales index, and a REIT index. Now, how is the real estate market doing? Can be measured using an appraisal based index, where indices based on appraisals to estimate value given market conditions. You want to appraise the properties, you want to get the properties valued. You rely on comparable sales and cash flow analysis, which is generally subjective. So when we say appraisal based index, you will, for example, hire Deloitte and you will ask Deloitte to value these properties and tell you what the value of the property is based on cash flow analysis, which is itself subjective. Because you're looking at cash flow analysis, you're not required to have recent transactions as a benchmark. The appraisal word itself means you are hiring someone to appraise the property, which means value the property. It generally provides smoother returns, and standard deviation is understated as appraisals are done periodically. Every quarter, Deloitte comes and does an appraisal for your portfolio. Let's say you are Blackstone. Blackstone has 50 properties in India. You hire Deloitte to do a quarterly valuation for all your 50 properties. And every quarter, Deloitte gives you, this is the fair value of your property or portfolio. That is an appraisal based index or appraisal based practice. The other way to measure performance is repeat sales. Relies on repeat sales of the same property. If the property was sold for $1 million last year in May 2023, and if it is selling at $1.2 million in this May, you will say the market has moved up by 20%. Repeat sale of the same property. Higher the number of sales, better is the reliability on this index, because you are getting more data points. It captures market conditions over 2 periods of sale for the same property. As I said, possibility that transacted properties are the ones with significant changes in value and may not be true representative. So you need to be very sure that the same property is getting transacted and there have been no changes to the property from last to this year, which can increase or decrease the value. Because then it will be very difficult to explain, is the value increase because of increase in market, or is the value because of increase in the value of the additions that have been done in the property. So you can look at repeat sales and figure out whether the market is doing good, the performance of the market is good or bad. Finally, REIT index. You can look at REITs. Have the REIT prices increased from last year to this year? If Embassy REIT has increased from last year to this year, which means the Bangalore market may have done reasonably well. Similar to equity market indices, Nifty Sensex can tell you whether the equity markets are doing good or bad. Investors must know the basis of construction of indices to track performance of these indices. You can use either of the three methods to understand whether real estate is doing good or bad. The risks of investing in real estate. We did talk about advantages, inflation and so on and so forth. They are inflation hedge. They are good from a capital appreciation, income generation perspective. But what are the risks? You are subjected to local and global economic conditions. Yes, any recession may push real estate prices lower. There are changes in government regulations. Government overnight can kill the value of a real estate property based on their regulations. Successful management of underlying properties is critical to generate returns. Yes, poor management of properties can lead to deterioration of the value of the property. So management of the property is critical. Expenses associated with a piece of real estate may become much higher than expected. Any upgrades, any changes, modifications, maintenance expenses could escalate based on inflation and the time taken to construct or upgrade the property. Investment in distressed properties and development properties is even more risky, and that is something which we have learned in India as well, that people prefer buying properties which are complete. You don't want to invest into properties which are under development because that could be fairly risky. Leverage is generally high and lack of liquidity is another concern. As I said, liquidity is not easily available in real estate. That is a major risk. Perfect. Questions on real estate? Any questions? We are left with infrastructure and digital assets. So let's take both of them tomorrow. I just don't want to burden you with all or these additional two concepts. So we'll touch upon infrastructure and digital assets tomorrow. But if you have anything else, happy to take questions. Else, I think we'll pause it here for today's session. Okay, perfect. Really good. If no questions, we will pause it here for today's class and I'll pick it up tomorrow with infrastructure and digital assets. I'll also try and see if I can set up a mathematical example for you for catch-up clause. I forgot to teach you catch-up clause using a mathematical example. So I'll try and see if I can get a mathematical example for catch-up clause for you. I just remembered that. And we'll complete alternative tomorrow. I can let me know wherever you need some examples. I can definitely add a bit more to it. Okay, perfect. Good then. Have a good day, and we'll meet tomorrow and we'll complete alternative tomorrow for you. Fairly small reading. Thank you.